Nice.
Oh, we got him. All right. Here we go. Do we got Garrett?
I'm here. Hi. I think
Awesome.
I think the name of this session should be I hate to say I told you so, but what we did. Actually, right on this show just a few weeks ago.
Multiple times.
Multiple
Yeah.
like 10 times, but anyway, I'm just it's so people are like, "Wow, we didn't see this coming." Really? You didn't see this coming?
It's out there for sure.
It's like it's amazing. You know, I got to say, people are amazing at how selective they can be at certain times. It just kind of blows my mind away. I mean, sometimes they just don't want to see what's right in front of their face. Hey, Ken, how are you? Not everyone listens. No, Bill, how are you? But I'm glad we got Don, and I'm glad we got this program where we can educate you guys. So good to do that.
Awesome. Well, hey, thanks everybody. Appreciate Roger, Celeste, Garrett. I appreciate you guys joining me today. We got some good stuff to talk about. Garrett, let's start off talking about financial conditions, man. I love talking about the Fed, all the big macro stuff. I know you got an extra grind there.
Easy topic.
And I'm pretty much with you on it too. So let's talk about it.
Yeah, I mean, if we look at the current state of the economy, as the market is just selling off right now, as Powell is speaking before the House of Representatives today, people who have a even smaller understanding of economics than the people that he spoke with yesterday in the Senate, coming out of that bottom, one of the key things that we've been watching is that 39.90 level. And that's because coming out of October, we had that kind of short-term bottom. That was a period of effectively very tight liquidity globally. That was a period where we were concerned about the United Kingdom. Remember the whole gilt process, what was happening with the Bank of England. So at the time, the concerns that we had, the dollar had effectively peaked. We started to see economic conditions start to expand here in the United States. And this was something that Powell was asked about back in January, where they said to him while he was speaking, when the market kind of peaked out at the top, the final, February 1st, February 2nd. They said, can you speak to the fact that the Chicago National Economic Index has been expanding at a very significant pace going back to October? And he said, we do not speak on the state of short-term economic conditions. And it was kind of just a signal that, again, if you look at liquidity in the system, right now we're up near 5% on the 1 year, 2 year bonds are now at the highest they've been since 2007. The expectation, the questions that are built around how much money is actually sloshing through the system. Because if we were to repeat what happened back in October where bonds were this high, why isn't the S&P 500 down around 3,600? Why isn't it down near 3,500 where it effectively bottomed out? Well, there's still a lot of money sloshing around. The Bank of Japan added $1 trillion to the system, which is more money than the Fed is tightening. Bank of China, or People's Bank of China, providing a lot of liquidity to the system. So there's still a lot of money sloshing around, and that makes a lot of challenges. Secondly, if you look at economic conditions, expansion of credit. How is it that the economic conditions came off the ground in October, expanded in November and December, and now you have that 2-month lag, which is why those numbers in January were solid for the housing market, solid consumer spending numbers, and the February numbers running hot. There is no coincidence that the expansion of the economic conditions are helping to fuel kind of these new concerns that we have around inflation. Once again, the Cleveland Fed saying 7.1 on the median on CPI. We still have a relatively hot inflationary situation, and a lot of it has to do with a lot of the money slashing around this economy.
Yeah, I want to, so let's kind of get, because people may not be as familiar with what you mean by financial conditions and affect. Liquidity is a funny term. Mm-hmm. Right here, what I've got is the index, the Chicago Fed National Financial Conditions Index. Bloomberg publishes one, Goldman, there's several of them on a global basis, and they all point to easing conditions, which is when you're below this line, it's conditions are easy, loose, and when you're above it, they're tight. And you can see this is exactly what Garrett, you were talking about right here. Up to October, it started to get tight. Basically, people thought, oh my God, how much is the Fed going to do, right? And then, it loosened up and it started to ease. And that's been the market ever since then. And there's a couple other things. And if you've got some stuff to share, let me know and I'll
That's the key chart. And if you go back and you look at what happened in 2020, and then you see back around April 10th of 2020, we had this big sell-off that transpired in February of 2020 due to COVID. But around April 10th, that's where the Federal Reserve dropped $4 trillion from the sky.
Yep,
and sure enough, the market absolutely took off. Well, we have been in the fastest pace of economic expansion since 2020. So that explains a lot of the movement that we saw. Not just, I mean, again, you have capital coming in from central banks around the globe, but the January rally was not terribly surprising. The point that I'm trying to make is eventually this has to stop. It has to stop at some point. So the Fed's going to continue to tighten. You've seen the odds of a 50-point hike go up. The Fed just tightened its balance sheet by $38 billion again last week. It'll probably be relatively robust again today. They do open market operations on Wednesdays. We'll get the SOMA number tomorrow. And then going through the rest of the cycle, the Treasury Department is engaging in its extraordinary circumstances situation right now to prevent the debt ceiling crisis. That'll carry through the summer. That liquidity is going to effectively run out. At some point, this is going to hit a wall. Consumer credit is hitting a wall. If this market keeps screaming higher, I keep saying the more people that buy into the delusion, the worse this is going to be on the backside. And I'm starting to see a lot of shades of 2007 where we saw expansion of conditions. We saw everybody saying the recession's not going to be that bad. We saw soft landing over and over and over again. We started to hear the words no landing. And right now, looking at the current status of everything, we have the highest interest rate since 2002. We have a housing situation that looks like Q1 of 2009. I don't know how many people remember that. And you kind of have to take a step back and marvel at the economic situation right now, because we're still not in a recession, because we're still kind of gaming that, right? We're selling a lot of our oil. We're selling strategic petroleum reserves, which gooses the export numbers that keep us elevated over GDP. Yet if you look in the actual productive parts of our economy, our housing markets, our durable goods, the numbers are miserable. Q4 was minus 5.5% in those two areas. And this is all going to continue to hit a wall until the Fed has to pivot. I commend Powell yesterday for not losing his mind on Elizabeth Warren when she was asking about the 2 million people who are going to lose the jobs, and she's asking about the sources of inflation. I would have looked her dead in the eye and said, it's you. You're doing this. I only have two tools that I can do to tame inflation. Unless you're going to raise taxes or unless you're going to cut spending, you don't see that happening. And unless you provide the supply side support, I don't see that happening. The Fed's going to have to continue to move higher. About a month and a half ago, CNBC cut an interview off when somebody suggested that we would have to go to 6% interest rates. I haven't flinched from that.
Nope.
They are now coming out. BlackRock came out today and said we may need to go to 6%.
5.8 to 6.
I agree. Yeah,
6.
Roger, Celeste, what do you guys have? I want to kind of back up. I want to kind of illustrate a little bit more of my thoughts on what's driving that growth and what's pulling this money into the system. But Roger, Celeste, I'd love to hear what you guys are thinking on this.
Let me just share my screen real quick, if you guys don't mind. I want to show you guys. And by the way, what Garrett just said about 0.75, I was just reading about an hour and a half ago. 0.75 is 0.50. Excuse me, 0.50 is now priced in at over 70%. And about 2 hours ago. So we're at like 71, 72% as of this morning before the market opened. It was in my morning video. But I want to show you guys something interesting. And I agree with what Garrett says. Powell doesn't have a lot of tools here, but this is the problem I'm having. You see, February 7th, I thought I was losing my mind when I was listening to him yesterday. I was like, wait a minute, didn't he say didn't he specifically use the term disinflation? And then I went online, and sure enough, Google doesn't forget anything. He did. Disinflationary process started February 7th. It's all over Yahoo. It's everywhere here. This inflation process has started. A month ago, disinflation. This is what drives me bananas with this guy. Now, here's the interesting thing. I read what the rest of the Feds have been saying, and I've really closely followed their comments. Everyone in the Fed who's made a comment in the last 30 days has pretty much said exactly what's happening right now, except for Powell. It's almost amazing. Where does he get off with this disinflation BS? Can't he just kind of just chill and say we don't know, we maybe. everybody else is playing the song and dance except him. It's like he just moved. So I find that very disturbing. I find that very, very disturbing. I wanted to start there. Now, technically speaking, and I got a couple of things to say here. I was actually surprised. I was really surprised when I looked at the 10-year yesterday, and I agree with everything that Garrett said. I've been saying 5.8 to 6% for about 3-4 months now. But here's the part that kind of struck me in terms of dynamics of the market in the short term. And I was kind of encouraged to see that yesterday the bond market didn't really sell off that much, the 10-year. I was expecting it to see it go down here. And then when I look, and as I'm speaking, as I'm saying this, keep in mind, this is the bond market and this is the Dow Jones. And they've been looking very, very similarly lately. And I found it very interesting that the Dow Jones also did not break support, and it's also starting to come back up. So I thought, in light of I thought that what he said yesterday was not good. He was honest, but I don't think it was very positive. But I was actually surprised at how well the 10-year held on in light of it, and in light of that, I'm kind of relieved to see that the Dow still remains choppy and did not break that support level. I honestly thought, based on what he was saying, we would see a break. So there is a silver lining, the fact that bonds are maintaining a choppy status quo, and I'm going short term right now. I'm not going beyond a 2-week period. This is a 2-week window. I'm kind of encouraged by what we saw. Earnings are behind us. Powell has given us the Grim Reaper outlook. The markets did not fall apart. I mean, 500 points, we really did need to see that. But I am starting to see more and more choppiness for the short term as a result. Now, let me show you guys some interesting things on momentum levels. And again, we've been talking about these every week we've been here. Now, I remember being here a few weeks back and saying how technology and consumer discretionary are not going to hold up. Well, let me show you where we're at right now in comparison to where we were. And remember, earnings are behind us. There is no more silver lining. We don't have anything to save the day now. So if you look at the chart, I'll just go 10 years. We're still going down. We're not going up. The momentum on consumer discretionary is going down. Momentum levels on infotech. And by the way, infotech is going to get a lot of, I don't know if you guys know this or not, but a lot of stocks are moving from the financial sector to info technology, like Visa, MasterCard. So I'm expecting to see a lot more market cap and more disjointed sector rotations. But nonetheless, this is the tech sector. It's moving down. But here's the interesting thing. If you look at consumer staples, on the other hand. Oops, wrong one. Our internet went from being so slow to being so fast that I now have a trigger finger. Oops, again I did the same thing again, second time. Come on. I want to show you.
We're jealous.
Yeah, like they went from like the worst internet to like the best internet in the world. Like I've never seen it so fast. Look at consumer staples. It looks like it's bottoming out, and it hasn't been around there very, very long. Also, on this show, I also said that I'm expecting energy. Anyone who thinks energy is done, energy historically moves higher when we have an inflationary period. But with that said, it looks to me like some of the stable sectors that have been coming off are starting to move higher. And so what I'm seeing is more upside in industrial, basic material, energy sectors, and I'm seeing more selling pressure or weakness coming into the consumer discretionary, technology, and infotech, which pretty much are all three of the same things. I mean, they all move in tandem. So I'm not really so I'm discouraged by what I'm seeing. I'm discouraged by what I'm hearing from Powell. I'm discouraged by what I'm seeing from momentum levels, but I am encouraged by what I'm seeing from the long bond, at least in the short term, and that gives me some encouragement that the market will not go down as fast as some expect, that the markets may stay choppy for some time.
I think Roger, I think on that, my view on the 10-year is they're pricing in recession, right. 9, 12 months, 18 months, and ultimately a Fed pivot. They're still doing that. I think they're going to have to come to grips with a Fed a lot higher than the market's even 6%. I think they're going to have to go a lot higher than that. But Celeste, I'd love to hear what you see. What do you think of, Fed meetings coming up? What are your views there?
Yeah, well, I think everybody's given a really great summary of what's been going on. I love what Garrett said. 100% agree with that, and you as well, Don and Roger. It's for how a lot further, a lot faster is kind of what he has said, and I think it's the thing that is sad to me is that the people that get hurt along the way. But I'm thankful for opportunities in the market going long and short, and that's what I try to do is take all this information and decide how can I make money in an environment like that. And so looking at the opportunities, looking at the different sectors, looking at the up and down movement with momentum is just very key, because that's what we have to do. We have to keep our head in the game. And because we know that the government is this overall economic cycle, the business cycle, everything, but this market is moving in and out as well. And there are a lot of people, a lot of pieces and parts moving with that. So, just looking for the opportunity. And I can share my screen if you want to go into sectors, Don, or if you have some other things.
We'll make that shift in just a second, Celeste.
Sure.
We'll go right back to you there, because I'd love to talk about some of those sectors that you're thinking about. What I really want to drive home is, we saw this kind of boost in demand, right? Garrett talked about, the consumer and financial conditions eased. Well, the Fed has been, not only are they raising rates, right, they're also taking down the money supply, right? And so that you would expect that to kind of tighten up conditions, right? But here's what happened. This is velocity of money, right? And so there are only a handful of old salts that even look at this anymore. When I first got on the board of trade, people pretended to pay attention to it, but the money supply guys were going. Now, velocity of money is an idea is how many times whatever base money the Federal Reserve has created, how much money supply, how much it turns over in the economy. And you can see ever since, the 90s, this velocity has been falling, and it's collapsed. Money supply since the great financial crisis has fallen off a cliff. Velocity has, because there was just so much money, right? And I've mentioned this a few times. Banks just sat on huge amounts of money. They didn't lend it out. Well, as soon as the Fed started threatening to raise rates, boom, they started to lend. It pulled people into the market. It scared people into borrowing. And that has created this tailwind, that is kind of, got consumption up, has held up various sectors and created this false sense of prosperity, right? That's the big risk of all this quantitative easing, is a false sense of prosperity and confidence, capital misallocation. And this is where you're seeing it. Even though the actual money supply is going down, there's less money in the system. It's turning over more and more. So it feels like there's a lot more. So that's, and this is just the beginning of the Fed's problem. When that velocity, if this continues higher, the Fed is going to have to tighten in order to fight that. And just one last thing here, and then we'll hop on that, Celeste, is I shared this on Ask the Pros a couple of weeks ago, is, look, the Fed hasn't even begun to tighten, right? Mm-hmm. They're still loose right here. And you can look at this. Actually, I say PCE deflator, but here I'm just looking at consumer price CPI. But whether you use CPI, core CPI, the PCE deflator, core PCE deflator, and you subtract that from the inflation measured on any of those terms is still higher than the Fed funds rate. So they're negative, right? The Fed funds rate is still effectively negative, the real Fed funds rate. And until you get up above into this red area, they're really not tightening. And they've got based on this, they've got another 2 percentage points just to go. And that's assuming inflation doesn't pick back up. Right. So, that's when Garrett's talking about financial conditions and the impulse that's been behind stocks, that goes a long way to explaining that. And whether or not the Fed has got religion, if they really have come to grips with what they've got, the problem that they have, we'll see. But I think that's going to be a lot of pain for the market, come this summer and maybe after this next Fed meeting, which is like a couple weeks away. But anyway, that's why I wanted to share that. And Celeste, hop in. Yeah, let's talk about sectors.
Well, before we do that, let's go back and talk about your, can you see that screen there? That was so eye-opening to me when you shared that on Ask the Pros, Don.
Yeah.
That's kind of what you were talking about. I made a copy of it. I went back and I listened to it. I took notes, that core PCE deflator. And that's exactly what you were talking about. And that was very, very eye-opening. It was fantastic. Everybody ought to go back and listen to that. That I thought it was interesting too. I just took a snippet of this from the economic calendar, Econoday. I don't look at this every single day, but I've looked at this, at this website for a couple of decades. I don't remember them ever, going back and changing a headline and even making a comment about, somebody doing something, Powell here, trying to combat inflation. I just thought that was really, really interesting that they drew that out. But
as a quick testament to how out of touch they are, right? Okay, so I studied economics in undergrad. It was on the bond market. That's all econ. Went to PIMCO. It's all econ. Went to grad school, CFA. I was 30 years old before I ever heard of Hayek, who it was Friedrich Hayek, Nobel Prize winning economist, right? And then I'm like, oh my God, this is exactly what I was supposed to believe, right? So these are the free market economists, the Austrians out there. So they talk about credit cycle and impulse and how much the Fed does to damage long-term stability. So they've done it for decades, all right? The Federal Reserve just released a research paper where they said no one has ever, and they concluded that long-term quantitative easing and loose monetary policy creates financial instability, all right? That was their like, oh my God, here's the big aha. And they said in the paper, no one has ever done a study or provided any evidence of, and I'm like, oh my God, they're even more clueless. This is their profession. This is how they get paid. And they have no idea the instability has been sowed by the Fed. But anyway, I just wanted to hop on that, Celeste. They're out of touch, and we'll see what they do with it.
Yeah. Well, we got to be prepared to make money no matter what, because that's what we're here for. And that's why we take this information and put it together to do something. Well, to do that as well, I thought it was interesting. I just took a snippet from my cell phone. There's the picture you can see there on the left of this rebalancing going on. I didn't know this had happened. Maybe some of you guys did. In December, the rebalancing of an index. This is the S&P 500 pure growth. And then there's also an index, the SP. I mean, you can literally type it into your Thinkorswim or whatever, SP 500 PG, SP 500 pure value, PV as well. So, but what they did was they changed the balancing around a little bit, and they do this periodically. But, to me, it was like, the CPA, the accountant in me is like, Roger, they moved the cheese, to steal your phrase, because they rebalanced it. It's like, so you can't go back. And if you're going to compare, you have to know now that you're kind of comparing an apple and an orange, and that's fine as long as you add that understanding. But what I think is interesting too is the way that they rebalance this. And, we've talked about, everybody here has talked about energy. It's not over. Well, if you look at the bottom left of that, I tried to blow it up there. Energy, the gold line is where they've rebalanced it to. I mean, way significant. The blue line to the left is where it was before December. So they've really rebalanced that. Healthcare, they have really rebalanced as well. So before December was higher, lower, but the real one is there in technology, really pulling, changing that balance. I think I said that wrong. The pre-December is the blue, the post-December is the yellow. So how they have really shifted that down significantly on technology. You can see, where materials is, all of the sectors that we talk about and we trade and that Roger just went through. That's how they are balanced right now. They're in this growth, S&P 500 pure growth. So what I think, my question is like, well, what were they thinking to make that rebalance? And I think those answers are very valuable to help us in understanding where the trends, where they see the trends, where we can see the trends. And I think we lay that out kind of week after week on programs like this. Here's the one for the S&P 500 pure value. And so, you can see that rebalancing as well, again, with the financial or the financials there first, just all of those going across the line, just some handy information to see how they're rebalancing all of those.
Mm-hmm. Yeah. Garrett, speaking of sectors and we've got war drums, beating around the world. Defense seems like an obvious sector play, but who knows, maybe, I don't know if that's all priced in yet in the sector. What do you see kind of in terms of what sectors are going to benefit? It's volatile. I don't think we're going back to 4,800 on the S&P. I don't think we're going to see those kind of things. So what do we do?
Well, I mean, my view is really always comes from the academic world. So, we're talking about sectors and talking about energy, and there's three places that I focused my career. And first is in what insiders are doing with their money. It's executives. Executives are at the lowest amount of insider buying to selling in 2.5 years. So they're not buying this rally no matter what. They're looking out 6 months. They recognize there's problems on the horizon. Secondly, I view the world through momentum, and we have, going back through some academic work of the Value and Momentum Trader, which was done by Wayne Thorpe and Grant Henning. You just bring it down to one reading and whether or not capital's coming in and out of the market, and it's been coming out the last 2 days. So I'm very, very cautious. The last thing, if you just combine F scores and Ben Graham numbers, if you just do basic analysis work that was done by Ben Graham or done by Wes Gray or done by Tobias Carlisle, and you just combine good balance sheets, good companies that are protecting their shareholder interest with strong Piotrowski F scores, it's a 9-point scoring system, and then look for something that's cheap on the value side using Ben Graham numbers, which are defensive, you end up with this wall of stocks. There's 66 companies right now, and they're all in places where a lot of people are saying, I don't want to put my money there. I don't want to be buying coal. Why wouldn't you want to be buying coal? These stocks are extraordinarily cheap. They have very good balance sheets. They're expanding for demand in Europe because they can't get natural gas from Russia. Why wouldn't you want to own companies going through this list like Earthstone Energy or PBF Energy or Antero Resources? Again, these stocks are really beaten up in this environment. It can be political due to the Department of Energy and all the things involving leases. There can be any number of reasons, but these stocks are very cheap and they're defensive in this environment. And if you're looking out 12, 18, 24 months, what you come to find is this strategy, according to a paper written by Borja Amor Tapia, Teresa Maria. It's called Separating Winners from Losers, Composite Indicators Based on Fundamentals in the European Context, showing that just doing this has beaten the market consistently for roughly a long time. I think it's 30 years. And it's a very simple strategy. It's the basis of what we do within our long-term letter and Tactical Wealth Investor for long-term value. But there's a lot of stuff here just in energy. Again, you don't have to own the stocks. You could sell put spreads on these names. You can go 10, 15% down, sell puts, generate income. If it does come to you, you buy it. If it doesn't, you get to pocket the money. And there's other sectors in this space that, again, military is obvious. Look at Northrop Grumman, look at LMT, look at Boeing. They're going to have to update the Apache helicopter at some point. The war drums are not going away. We're still going to spend nearly $1 trillion on defense a couple of, 10 years from now. But it's the energy space, it's the housing space, it's the renewable energy space. All of these things are going to be major problems moving forward. Russia, Belarus, and Ukraine are 40% of global potash supply. That is an industry that's getting beaten up right now because of oversupply in the Midwest. But if prices keep getting cheaper on potash, buy those stocks, Mosaics, CF Industries. We just took a 30% gain on Mosaic yesterday because it was up 30% to start the year. If these companies pull back, buy them for the long term and do it with both hands, because these are well-run companies, very defensive companies, trading for well below their defensive valuations.
Right. Yeah. No, if we end up in a fire sale situation, right, the first thing that institutions will do is they sell the big winners, right?
Yes.
You think they get out of those. And if you've got these value stocks that have been unrecognized, they tend to hold up definitely on a relative basis. But the other part of this, and it's remarkable that there's so many, I was actually really surprised to hear you say that there's so many resource names in this 66 list of 66 stocks, right? There is, because, the energy sector, parts of it went gangbusters last year, right? But resource constraints, you talked about capital a little bit. The underinvestment in resources, the capital underinvestment in resources has been a 20 to 25 year now phenomenon, right? And the energy initiatives cannot be met.
Yes.
I don't know if you guys seen that video, how cobalt gets pulled out of the ground to put in a lithium ion battery, but it's criminal, right? That is those constraints on the renewable energy sector That's why India is going all about coal.
100%.
Right? China is refiring coal plants. Germany is refiring coal plants. I mean, there's the resource scarcity that we have to face over the next 10 years. And the constraints that puts on the energy sector doesn't mean there's not a bid. It's just that the capital it's going to move as much as it possibly can. I was surprised to see that they're still asleep at the wheel. People don't appreciate it yet.
I have this on my desk. I think I read it last time. I haven't removed it from my desk because I remind myself that there's always money here. And you have to go 3 times the copper, 10 times the lithium, 18 times the graphite, 4 times the rhodium, and 8 times the cobalt to meet the demand of the expectations in 2033. We've never doubled the industrial capacity of one metal in a decade, and we have to do it. We have to do more than double, triple, quadruple. I don't even know what 14x is. There's probably some, term for that. I don't know it off the top of my head, but there's 15 different metals that we have to 8, 9, 10 times the capacity. So again, the capital is going to scream into that. There's going to be a moment where momentum goes very positive in some of these sectors, and you're going to want to be on board. But you can bring it down to one day to know when that capital is screaming into those sectors. If you want to buy and hold now, I'm not going to blame you. If you want to wait for the optimal time, we tend to know when that happens.
Yeah, that's awesome. I just learned this too. Silicon, you think it's just sand on the beach, right? 95% of all silicon used in semiconductor manufacturing is pulled out of a mine in North Carolina.
Yep,
that's amazing. You can't refine it. You can't go to the beach and pick up sand and refine it in a way that makes it economical to do a semiconductor. 95% cut. So yeah, there's some interesting scarcity that's going to crop up. Roger, I'd love it. Thank you for being so patient, man. I want to hear.
I was just I'm listening here, and I'm just going like we've been. Since the war started, we've been talking about Mosaic and all those things. This is, I couldn't agree with you guys more. I'm just shaking my head going absolutely 100%. It's a no-brainer, like Mosaic, a couple of metal companies, Nucor. There's a lot of, and let me tell you, the war, I think once the war, and nobody knows how long this war is going to last. There's a lot of these minerals, and correct me if I'm wrong, Garrett, but there's a lot of these minerals and a lot of these natural resources right at the border between Ukraine and right. And I think once this war, and I'm only repeating the words that I said exactly a year ago, once this war, once we know where everything is, and once Putin maybe dies, I don't know, once it comes to an end some way or another, I think we're going to realize how screwed we are with those minerals and how much of a demand we have. And that's not even including a food supply problem that I'm foreseeing in the future. So I think this is completely on the level. I don't think you guys are being paranoid or looking all that much forward either. I think this is this is look. I've been saying this for a very long time. There's a reason why Mosaic is going up right now. When the Dow's not, there's a good reason why Nucor is going up right now. There's a good reason for all of this. And let me tell you another thing. With COVID now, I haven't heard a word about COVID in 2.5 months from China. I think once China gets going, I think we're going to see a bigger demand for these type of resources. So I am 1,000% in agreement with you guys, and I think it's going to become a bigger problem as we get closer. I think it's like almost like a double-edged sword. No matter where we go, it's going to bite us in the ass at this point. Mm-hmm. So I think it's just a matter of time. But yeah, people do not realize. People think. About 4 years ago, when the markets were really strong, I remember all this talk about electric. When they start having planes and cruise ships and all of these things function on electricity, then I'll start getting into it. I mean, we're nowhere there. Do you know the amount of carbine it takes to run a commercial operation versus like a regular car? It's apples and oranges. We're still in the infancy stage of that. We need traditional oil for. So yeah, I think that all of these things, and I think that's where the market is going to start focusing more and more in the coming months. The materials, the industrial, the energy stocks. I think that is going to set off trends. Paul Tudor Jones and Stanley Druckenmiller. I don't know if you guys listen to them, but they're both self-made billionaires, and they know a little bit about the market. They both said about a year ago, we're going to be entering into commodity super cycles. Well, guess what all those things we're talking about, all those resources are? They're commodities. They're commodities. And you don't typically see commodities go for like 6 months and die off. When they move, they start moving. Historically, look at it. It's always happened this way, especially if the market gets into a very saggy situation where it is right now. If interest rates keep going higher, I think there's going to be a huge demand for these things. So I'm 1,000% on the same page as you guys on it. I think it's only a matter of time and reality, and I think eventually people are going to get tired of hearing all this. You know, you have politicians right now driving the economy who should have been hired as press secretaries during a presidential administration. They're good at spinning things, but they're just not being accurate with us. And I think if people really realize that what we're talking about on this show is a reality, we're not giving opinions. We're looking at supply and demand here over time. And guess what? That's what market's based on. I think everybody will see that we're not in as good of a situation as a lot of people think. And all of these new developments that are supposed to have been coming our way, they're nowhere near where they're supposed to be. They're nowhere near. The world is still a meat and potatoes world, folks. And Jetsons are not coming anytime soon. AI is great, but it's not going to save the day. You know, sorry, I needed to get that out of my system.
No, that's great. That's great. But, you know, I mean, Roger, I think you've got some ideas on stuff that's going to work over the next few months. I mean, not everything's going down. You know, Garrett sees some value plays out there, you know, in terms of true valuation, and Celeste sees this rotation, which is also going into this value, right? I mean, that's kind of what you're seeing, and because growth isn't giving growth, right? Tech has priced, you know, they made it on easy money, and easy money is starting to turn. So what are you seeing out there?
I think we're going to start seeing more accumulate. I think from what I learned this morning, Warren Buffett just bought more Oxy. Okay.
Correct.
I think we're going to see energies rally again. I think we're going to see basic material really start moving hard. I'm seeing a lot of accumulation coming into utilities, which are short-term oversold right now, and energies. I would be fading I think fading technology is a very smart idea right now in the short term. I am positioning myself right now kind of like where we were. Let me give you a good example. When did things get really dire? Before this last February 7th, around November, December. I'm positioning myself much more like we're coming to the end of last year than we started coming this year with you know, pink sunglasses on and seeing these things. I think that some stocks like casino stocks are seeing a reprieve due to China, but I think once economy really catches up with the reality, really catches up with Wall Street, I think those are going to be very vulnerable stocks. I would focus on energy, utilities, industrial, boring stocks that are not fun, stocks that are not really, stocks that are not, like United Rental, GE, Monolithic Power, those Mosaic, those type of stocks I would be focused on. Boring traditional stocks that we really don't talk about very much. That's really where I see the money. And by the way, momentum levels are confirming exactly what I'm saying right now. Yeah. Also, just want to show you guys something interesting, if I may. Do you mind if I share my screen just for one?
No, please do.
Wanted to show you this. This is something that Celeste knows about this. I do this all the time. I look at my sectors, and this has been a very good indication of how whether we're overbought or oversold. I just want to share this with you. It's worked for probably the last 2 decades for me better than anything I've seen, and nobody really talks about this. So here's all the 11 sectors. Notice technology, communication services, and consumer discretionary, they're away from each other right now. That's telling me the market is still overbought. It needs to come off from what happened in the beginning. When markets are, it's telling me that the market is still fragmented and still stretched out, and it needs to cool off some more before things steady out. I think we're going to see utilities. I think we're going to see consumer staples. And I think these 3 sectors are positioned perfectly right now. So energy is now number 1 again, like it ended in 2022. Industrial, basic material, but there's no business for technology, communication services, I think they're all going to come right back down, and these sectors are going to start coming up. I'm seeing a really sweet spot in utilities and consumer staples right now. I think that is a low-hanging fruit right now. That's my opinion.
Now, and you got something coming up at 1 o'clock today. Is that right, Roger?
Yes, I have. And maybe somebody can maybe drop the link in the chat. Yeah, I have a class today at 1 o'clock, and I'm going to be showing people exactly how I pick stocks for not for 3, 4, 5 days, but for a month, 2 months, 3 months. You know, one thing that I want to tell people, and this is really important, selecting the right stock is half the battle. It really is. I don't care if you are a pullback trader. I don't care if you're a breakout trader. I don't care if you're a Fibonacci trader. I don't care if you're a seasonality trader. Picking the right stock is half the battle. And right now, I'll tell you guys something interesting. I'm seeing a lot of stocks that are rallying and are doing really, really well that shouldn't be rallying, in my opinion. And there's ways to kind of weed them out if you know what to look for. So today at 1 o'clock, I'm literally going to be telling you how I find my stocks. I use this. What you're going to be learning is you're going to learn how I find them, how I use diversification, whether hedges help. So if you want to learn how to build a hit list for yourself, maybe hit list is a little vulgar, a watch list for yourself, so you could use it for pullbacks, or you want to trade these stocks like momentum, which we do in the program, I'm going to teach you how to do that at 1 p.m. today. It's going to be a very educational meat and potatoes class. It's only going to be about 45 minutes, and I cannot wait to share it with you. It's going to be Eastern time. It's going to start in about 2 hours and 19 minutes. And I'm very excited. There's going to be some hot picks. And I'm going to give you guys, if you stay till the end, I'm going to give you a list of my top 15 stocks that I'm really, really bullish about right now. That wasn't even planned. I'm just going to do it out of the goodness of my heart. I want you guys to have a hit list of the best stocks right now. So that's going to be included with it. And you'll see exactly the kind of stocks I'm targeting right now. Follow the link. Sign up. It's happening at 1 p.m. Eastern time. The link is right there. You could sign up for Telegram. You could sign up for SMS, and you could sign up on this link there, but it'll take you to the same place. And I think right now, missing these type of sessions is not a good idea. I'm a really realistic kind of guy. I don't have a preconceived notion. I listen to everybody. I listen to what Don says. I listen to what Celeste says. I listen to what Garrett says. Everybody has a lot of very important things to say right now, especially people who have economic backgrounds. The market, the fundamentals, and here's probably the most important thing I'm going to tell you guys today. The fundamentals and technicals, they can go their own separate way, but eventually they catch up with one another. It's just a matter of time. And what I'm hearing from Garrett is that it's coming sooner than later, and I unfortunately have to agree with him and with Don that just things are just not looking all that great. Did you guys see the earnings revisions from last quarter from 1.2 to 9? It's like this. Have you ever seen the EPS go down from 1.2 negative to 9% in 2.5 months? That's not good. That's very, very, very bad. Very, very, very bad. So I think that the market is kind of I think the market is still has a lot of hope in it, but I think it's going the balloon is going to be popped, and I think that balloon is going to be popped sooner than later, and I want to make sure you guys are protected on the right side. Listen to what these guys are saying and join me for my 1 o'clock session. I think you're going to have a very, very good time, and you're going to learn a lot. So bring a paper and bring a pen.
Well,
that's so Roger, those names. So you see this. This is something that's names that they can buy now. Hold them through the summer. There's a process too that they can continue to go with. But these are names that you can jump in now, and you see a lot of momentum, a lot of upside in these guys over the next few months.
Yes, and these are I call these my 12-week trend holds. So okay. I find these stocks are going to be good for the next 12 weeks, and they're going to be perfect stocks to trade on their own, to buy pullbacks on, basically stocks that are super, super resilient in the current economy right now. So I'm going to give a list of those for anybody who comes in. And actually, Raleigh, I'm going to give 15 of them. That's right, not 5, but 15 of them. So, and it's brand new. It's not some pre-recorded mumbo jumbo. I don't do that stuff. It's all live. So please stay tuned. Be there at 1 p.m. I think you guys are going to have a great time. You're going to learn something new, and you'll hear me talk about my frustrations with Powell. I mean, that guy just gets me every time. That's what I've got for you guys today. Sorry, Don. I had to let it all out. I honestly thought I was dreaming when I remember. I was like, didn't he use the word disinflation? And I looked it up, and boom, it was right there.
Yeah, no, they are not quite. I mean, they're trying to talk the market into doing the work for them without them actually having to hike rates. But I think they're realizing that the market is saying no. I mean, look. So on your point there, earnings dropping 9%. Well, price didn't drop. So what's that do to PE, right? the denominator goes down, but price stays the same. PE just stays just as lofty and elevated, overvalued as it has been. So there's plenty of room.
And what about all these? How about all these layoffs? Meta just announced this morning that they're doing another round. I mean, like, are people not like? It's almost like people we're going to be in a bull market, and it's going to be because I said so. A few weeks ago, Garrett, actually, you may be, I don't know how you feel about her, but the president of ECB was on Christina. How do you pronounce her last name? Lagarde.
Christine Lagarde.
I thought she did a very good job. She was on 60 Minutes, and she was very straight up. She was very straightforward, and she said, "We're going to have to do a lot more than this. We're not done yet. This is not. We're just getting started. There's going to be a lot of tips and tricks that we're going to have to pull out of our what to get this done." She was very straightforward, and she doesn't have a political agenda in the USA. So if you guys get a chance, listen to the 60 Minutes session. I think it was 2-3 weeks ago. It was very telling, and it actually explained a lot about her background, and it was a very, very, very good show. Highly recommend you guys watch it.
Yeah. All right. Excellent. Well, hey, you guys, make sure you sign up, click that link, and join Roger at 1 o'clock. I think you're going to learn a lot. This isn't it's not a one-way market. You're going to have to pick your spots, and I think Roger's got a lot of insight to help you guys figure out how to get through it in the next few months. So, hey, Celeste, thank you, Garrett, Roger. Appreciate you guys joining me today. This is awesome. All right, appreciate you guys. It's been a great session. Love you guys for joining, and we'll see you next week on another roundtable.
And follow the link. Thanks, guys. It was really nice being here. Great session as usual. Bye, Garrett. Bye, Celeste. Bye, Don.
Have a great day.
All right. See you guys.
Hey there, folks. Well, listen, I want to thank you all for coming to this week's edition of the Roundtable. I thought that was terrific. The kind of insight that we get when we bring these four experts together and they just start riffing on what's happening in the market, what they see in the news, how they're digesting information. I mean, they're providing insights and things that I just don't think we're totally sensitive to. And I just think it's fantastic. So along those lines, we'd really like to thank Celeste Lindman, Garrett Baldwin, Don Yoakum, and Roger Scott for the time that they spent with us today. And you know what, guys? This happens every Wednesday. Every Wednesday, Don is bringing excellent people just to talk about what's going on in the market. And what we hope that this is providing you with some additional knowledge and insight on how you can just get a better grip as to what's going on and ultimately how that could impact your trading and investing. With that, folks, I'm going to leave the music on for a little bit more. I do encourage you all, I totally encourage you all to sign up. I put the link in there. Take advantage of coming to hear Roger's webinar this afternoon. That's a free webinar. And, he's going to be covering an awful lot of great material. So take advantage of that. And we'll see you next Wednesday. Take care, folks. Bye-bye.
What you say?